Hey folks, Frank Zavilla here, Zor Capital, Friday, 6 o'clock, October 26th. So today officially we enter into the correction mode. The S&P 500, although it's only down 0.5% year to date, as you can see right here, is down 10% from its 52-week high, which was just the other day. I think at the beginning of the month or something like that. So officially, if you believe in things like we're in the correction just because we're down 10%, well, we're there now. Uh, Same thing with the composite, with the Nasdaq, which is up almost 4% year to date, but it's down 12%, 13% from its 52-week high. Again, it happened I think this month. The IWM, the small caps, first went to peak back on 920, down 16% from its 52-week high, and down roughly about 3% year to date. So year to date numbers don't look so bad. The carnage that we've seen over the last couple of weeks a lot worse. Also, some other ETFs of interest, momentum ETFs, the IBD 50, 50 names in that ETF, down 7% year to date, down 21% since its 52-week high, which was just this month. Also, MTUM, which is a closet, in my opinion, S&P 500, just with 350 names, down 13% from its 52-week high. Another momentum ETF, PDP, DWA, technical leaders, down 15% from its 52-week high. That just happened just the other day as well. So officially we're down, like I said, 10% from the highs. Year to date in the S&P 500, we're pretty much flat. I mean, those numbers don't seem that bad at all. I mean, down 0.5% for the year, it doesn't seem bad at all. But the problem is that most individual investors and most people own individual common stocks. So if the S&P 500 is down, call it 10% from its highs, individual stocks are down probably a lot worse. So I mean, let's just see if that's the case here. Let's just switch this to the S&P 500, and let's see what some of the biggest losers are from their 52-week highs. So here you have, for example, Nektar Therapeutics, NKTR, down 66%. Let's see some of the names that we know. Wynn Resorts down 50%. AMD, which was just a big winner, down 48% from its 52-week high, which was just probably recently. AMAT down 48%. GE down 46%. ALGN, which was a huge winner, it's still up 3% year to date, but it's down 42% from its 52-week high. eBay is down 41%. EA, which was a big winner, down 36% from its 52-week high. Let's see some of the big names here. Let's see, Apple's holding up well. That's only down 7%. But let's take a look at Google. Google is down 16% from its 52-week high, which was just recently. Let's take a look at Netflix. Where is this? Netflix down 29% from its 52-week high. So individual stocks are faring a lot worse, obviously, than the indices, and that's probably the reason why people get concerned about the market. I mean, we're down 10%, but every time that we're down this amount, I always post this chart on the blog or on Twitter, which is the annual returns of the S&P 500 versus the intra-year declines. For the last 38 years, according to JP Morgan, the average intra-year decline has been 14%, which means that it happens often. I mean, quite often. Some years it might be more, some years it might be less, but the average is 14%. Here are some of the outliers, 34%. This was 1987. And everyone talks about these crashes, okay? Crashes are outlier events. They don't happen that often. And as a matter of fact, if, I would much rather have a one-day crash than a 9-month bear market. That's just a fact, because 9-month bear market like we had back in 01 or 2002, those are brutal. Even for the shorts, because During these bear markets, when we're underneath the 200-day moving average, we have the biggest rally. So it's not that easy. Shorting is not that easy as some people make it out to be. There is no doubt money to be made because stocks go down a lot quicker than they go up, and you can see that in the S&P 500, more than anything else. In the S&P 500, we took the stairs up, and it took us 6 months to make whatever it was, 10%. It took us a couple of weeks to lose it. So we're taking the stairs up, the elevator down. But regardless, shorting is not that easy. So everyone talks about these crashes. In 1987, yes, we had a one-day crash. But no one talks about the upside crash that happened right afterwards. Okay? The market actually closed up 2% for that year. We also had a flash crash, which lasted a couple of months. But the point is that I just don't bet on outlier events like crashes. This year, intra-year declines happen on a yearly basis. Yeah, that's it happens. That's a much better bet, and I think that that if you can't withstand as an investor the average decline on a consistent basis, then you have issues. It's going to happen. You can't expect to make S&P 500 returns without having some down periods, months, years. You can't avoid losses. All you want to do is contain them, okay? And the way you contain them is very simply when you have individual common stocks, you have to have some type of stop loss, some type of exit strategy, because unlike the indices that have a tendency to come back over time, some individual stocks never come back, okay? The biggest leaders, Lucid, whatever. Look at GE, look at IBM, look at Eastman Kodak, look at Tandy Computers, Compaq Computers. So when you own some of these individual names, I always recommend that you take your stops, all right? You take your losses. You can always get back in. We as retail investors, we have an advantage over the institutions. We can click the mouse a couple of times and we're fully in cash, something that I don't recommend, okay, to go 100% cash, but that is an option. Institutions, they can't sell their shares overnight. It takes time. So we have that advantage, and we should use those advantages with the individual stocks, because if you have them, you take your loss, and believe me when I tell you, you're going to feel better. And you can always buy them back when things turn around, which they usually do, all right? In the market, what we want to do is we want to preserve our capital, and we want to preserve our mental capital, because the market is going to trend really well for 3 months. That's where the money is made. And then the rest of the time, it's going to go back and forth, back and forth. And all you want to do is just keep that money that you earn. But if you don't have that mental capital, you don't have the capital intact, you can't take advantage of those good times, okay? So, look, we might crash on Monday, whatever. It's an outlier event, something that I don't talk about unless I'm talking against it, something that I don't bet on, because it just usually doesn't happen. It's like a pitcher pitching a perfect game. It's like a basketball player shooting a shot from the other side of the court to the other side and making it in, on a one-shot trial basis. So it's hard, because it is, for all we know, we'll crash. But believe me when I tell you, if I had a choice between a one-day event and a 9-month bear market, I'm taking that one-day event. So let's take a look at the S&P 500. There's really nothing to look at besides the fact that this is IBD 50, which peaked on 10/1 October 1st, which is just this month, and it's down 21% so far this month. I'm a big fan of buying the indices when there's blood. I mean, that's based on the stats. Okay, I'm a big fan of doing that. When we get a rebound, we get to these places where the market gets oversold and we go down, that people start to forget that the market goes up and down, not up or down. That even during the worst times, back in 2008, the market, had rebounds along the way. It's just not all downhill and we're never going to look back. The market had rebounds along the way, and some of them were explosive. You can't tell much from here, but this is 120. This is a 10-point rebound from here to here, which is roughly about 8%. in a matter of a few trading days, 20 days. Here we were at 125, we get to roughly 145, that's 20 divided by 125, that's roughly 16%. Right over here, we get down again to 125, we hit 140, that's about a 14% return. So you get these waterfalls like we did here, but you get these explosive bounces, and that's the reason why shorting is tough, and that's the reason why I'm always a big fan of, having these up days and these dead cat bounces to take some off the table if you actually believe that we're going lower, okay, which is a possibility, all right. And again, let me reiterate, the indices, specifically the S&P 500, Dow Jones, QQQs, they have a tendency to move higher over time. Okay, so you can be more lenient with the indices. With individual names, that's a different story. Okay, that's a completely different story. Some of these things never come back, and they go down a lot more than the indices. Okay, some of these stocks, some of the S&P 500 names like we saw are down 60% from their 52-week highs, 40, 50%. That's a lot. And I mean, let me just show you again here, so we know exactly what we're talking about. All right, so let me just show you. So now what I did was I put the QQQs so we can see some of these names. And look, I mean, WDC, Western Digital, down 58% from its high, which was back in April. JD down 55%, which was right over here at the beginning of the year. Wynn Resorts down 50% from its Jan peak. X-Ray, 50%. AMAT down 48%. NetEase, as you can see here, down 46%. Dish down 46%. I mean, we have, let me just, here we have roughly, we have a bunch of names, probably more than half. We have, more than half. We have 54 names in the QQQs that are down 20% or more from their 52-week high. Okay, that's a lot, and that's the reason why people get concerned. The indices, they're not down that much, but most people don't have 100% of their portfolio in the S&P 500. They own individual common stocks, and they're getting hurt. And this is the reason why, another reason why, if you have the individual names, take your stops. You can always buy them back. And believe me when I tell you, once you take that stop, you get that weight off your shoulder, you think clearer, and you can always get back on board. Now here I'm looking at the 30-minute chart. The 30-minute charts of some of the indices, the QQQs, the SPY, the IWM. I have the SMH and XBI, two risk on, risk off ETFs, okay? And I got a whole bunch of moving averages here on each one. And very simply, when we get oversold the way we are now somewhat, these indices, what typically happens is that the sellers are in control, and these averages act as resistance all the way down. As you can see here, they've just been acting as resistance. Okay, and eventually, once we start to make that turn, what typically happens is you get some type of inverse head and shoulders pattern, where we get that first low, then we get that quick bounce. People are quick to say, hey, this is the low. Then we break that low, that becomes the head. Then we bounce higher. Once we get that bounce higher, no one believes that bounce is going to last. We get another pullback to form that right shoulder, and then we're off to the races. And then what typically happens is that you'll see these moving averages, you'll see the price get above these moving averages, and you'll see these moving averages start acting as support, as we are seeing now with the VXX. So you see here with the VXX, resistance, 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 finally gets above. Now that it's trending higher. Over the last couple of days, we've had some significant bounces in the markets, but they've been they've been stalling right at the 5-day moving average, which is this red line over here. Okay, but we're getting there. We're hitting it. Now these averages are getting closer. Now what we want to see is these averages start to flatten out, and we want to see the price start to get above these averages, and then for them to start acting as support. Now I'm going to show you, some of the things that I get a little bit more active on Twitter, on social media, when the market's under pressure. That's just my nature. Just to, when we're down a lot, when we're down 6, 7, 8 days in a row, we're down 8% in a week, and I always try to look at the bright side, because I'm a firm believer that the market goes up and down, not up or down. And people tend to forget that fact when we're down a lot, or when we're up a lot. All right, so when we're up 7 days in a row and the market is going up and there's no turning around, people become bullish, and we're going up forever. We're never going to pull back. And when we're down, the exact opposite, down 7 days in a row, no one remembers some of the good things or some of the things that can actually go right. Or what they're talking about is, we're going lower, 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 which is a possibility. But the market, it's always a two-sided market, okay? It's just certain times the bulls are in control, certain times the bears are in control, but it's always a two-sided market. So here's NIHD, a stock that's been holding up well, relative well versus the market. If you believe in relative strength, the assumption here is that if we get some type of relief in the market, that the stocks that have held up well will explode higher. That's the case sometimes it's not, just like everything else. Ever since 2009, I believe that the weakest stocks have, bounced a lot better and quicker after oversold corrections than the ones that have held up, that held up the best, okay? You can find 100 examples of stocks that held up well, that continue to do well after the market started to move higher, and you can find 100 examples where they did. And you can also find 100 examples of stocks that were trading at 52-week lows and bounced 100% after the market started to move higher, okay? So you have to keep a list of the two of them and see how they trade after the market starts to move higher. So that was NIHD. ULTA is another one that's held up, pretty well. This is the weekly chart right over here. Still trading above the 50-day moving average. This is one of only 3 IBD 50 names that's trading above its 50-day moving average. It's holding up well, in my opinion. All right, so this week we had some washout levels. As far as stocks down 25% or more in a month. Typically, when that number gets above 250, we see some type of oversold rally. Doesn't mean that we've seen the low, but we see some type of oversold rally. So this week on Twitter, I pointed out a few occasions, like back when we had some big corrections, like back in August of 2015. When we had a similar correction, the IWM was down 17% in a matter of a couple of weeks. We had 293 stocks that were down 25% or more the previous 30 days, which was the peak at the time. And the next day we had a decent bounce in the market, and we had 808 stocks that were up 4% or more that day, which is a huge amount. That's a large number. The following day, we had 939 stocks that were up 4% or more that day. That's the reason why I'm a firm believer that if you believe we're going lower, you got to take these bounces that we normally get during oversold corrected markets, which normally are big rallies. You got to take these bounces and take some chips off the table if you believe we're going lower. And there isn't a better time to do it than when we have these dead cat bounces. Okay, we had a similar situation. Right over here a month later, where we had 257 stocks down 25% or more in the rolling 30 days. And right after that, we had a bounce on 9:30 where we saw 606 stocks up 4% or more that day. We saw on 10:2 787 stocks up 4% or more. And then we saw on 10:5 981 stocks up 4% or more. These are extremely large numbers, okay? Typically, we might see 150, 100 on any given day. This is 606, 787, 900. We had a similar. We had a reading like that just this week of roughly about 600 when we had the rally a couple of days ago. Here's a little experiment. That you can do on your own, which is here are the stocks that are holding up the best. They're 0 to 10% off the highs. Okay, so we're going to track these stocks, the top 20, to see what's working best. Relative strength or relative weakness. So this is a relative strength. Names: Apple, Johnson & Johnson, Pfizer. I put them via market cap. I rank them via market cap. Here are the relative, the weakest links across the board: Facebook, BABA, Bank of America, Wells Fargo, Intel, TSM. As of today, as you know, 1 day or 2 days later, the weakest links are performing slightly better than the strong names. So here's the IWM 2-day chart. Here's the 8/24, 2015. We had this pullback right over here. Look, these are big rallies over here, by the way. These are 10%, 8 to 10% rallies. So they're pretty big. So they happen even during corrective markets. So typically here, when you have these big red candles, this is what people are calling for a crash, especially if it's on a Friday like today. We might crash on Monday. That's a possibility. Who knows? I just don't bet on outliers. And even if given a choice, whether to want a 1-day crash event or a 9-month bear market, I'm taking that crash event, okay? Because that crash will be a 1-day event versus a 9-month bear market, which is brutal, all right? Especially if you don't short, okay? Which you can short, but even if you do short, it's not that easy, okay? But either way, here's 8/24, 2015. The world was coming to an end. It looked horrible. We had bounces along the way. This is October, November, December, so we rally at the end of the year, which is a possibility now as well, especially given the fact that historically midterm election years, the last 3 months of a midterm election year, they're typically positive, so you can't rule that out. And then, maybe similar to 2016, by the end of December, we crashed again, or we sold off again to the tune of 12% in a matter of 8 days. And then we had some decent rallies along the way. This was about an 8% rally. You can barely see it. And then this was a big rally here. This is January 2016. And then we had this little sell-off here also, which was Brexit. Then we had the elections. Then we had the beginning of the year. So all these things are normal, okay? Like I showed you here, all these things are actually very normal. And like I said before, you have to be able to withstand the average drawdowns on any given year, all right? You can't avoid the unavoidable. You can't avoid losses. What you want to do is contain that loss. You want to contain those losses as much as possible. You do that by taking your stops in the individual names, specifically the individual names, and you allow yourself the opportunity to live to fight another day. It's not always sunshine and rainbows. You're not going to make money every day. Chances are that you're going to make a bulk of your money in a small window. 3 months, okay, out of 12. And you got to stay in the game and do your homework every single day, because we have no idea when that window is coming, okay? All right, so, like I've been saying, corrections are not fun, but they happen on a consistent basis, and you have to be prepared for these type of things to happen, and you have to be proactive, in my opinion, specifically with your individual common stocks, because they don't always come back, and when they correct, they tend to correct in a very big way. And if you don't cut them when you're supposed to cut them, okay, if you're down whatever it is, 50%, now they have to go up 100% for you to break even. So you need to be able to cut your losses. They're nothing but letters and numbers, and you can always buy them back when they bottom and they start a new uptrend, or you buy something else. But as far as the indices, the S&P 500, this is some stats from 1950 to 2015. How many 5% corrections from all-time highs we've had during that time frame? 61. We had a few over the last couple of years, so you take this to 65, okay? It happens all the time. Right now, how many 10% corrections we have from all-time highs? From 1950 to 2015, it's 20. We have one now, 21, 22, 21 now, January, beginning of this year, 22. And then we had also, we had one in 2023, 24, okay? From 1950, that's 65 years, so we had 24. How many 20% corrections from all-time highs? We just saw an all-time high in the S&P 500 just recently, 9%. This could be number 10 if we crash on Monday like many are calling for. Or it could be, number 10 if we continue to go down, over the next, whatever it is, 3 to 6 months, and we go down an additional 20% from here, an additional 10% from here. How many 30% corrections from all-time highs? 5. A possibility, that's 5 out of whatever it is, 65 years. How many 40% corrections from an all-time high? 2 out of 65 years. How many 50% corrections from an all-time high? Just 1. Unfortunately, nowadays, every time we get a 10% correction, people believe it's going to be a 40 to 50% correction, which is a possibility. It's probable, but it's a very low possibility. So I'm just not a big fan of betting on outliers. I'd much rather accept the fact that the market does go down, right? Accept the fact that when we're down a lot, it's not going to feel great. All the bearish articles always sound 10 times better and read a lot better than the bullish articles, okay? We can always relate to bearish things, okay? We always can. So they sound better, but these are the stats that of what's happened in the past. And again, these are outlier events, 50% correction from all-time highs, 40% to outlier events. This is more like it. 10%, 20% is a possibility. So that's what you want to shoot for. Let's say, for example, you're concerned right now, just ask yourself, how am I going to feel if the market corrects another 10%? Okay, what do I need to do now or come Monday, Tuesday morning to get myself at a place where, another 10% is not going to bother me that much? That's what you want to think about. And like I said, you have to be extremely diligent with your individual common stocks. In my opinion, depending on your age, how old you are, you can be more lenient with the indices, but with the individual names, you have to cut them, and you have to cut them quickly. All right, now I'm going to show you some of the things that can go right, okay, from these levels. Possibility, okay? You always want to try to see the light at the end of the tunnel. You want to see what can go right when we're down as much as we are in such a short amount of time. So here, the stat from Art Stats, a great stat guy with a sense of humor. In case you forgot, in October, November, and December have been extremely bullish for the S&P 500 and midterm election years, data since 1951. So the median monthly return for the S&P 500 during midterm election years, 2.5% in October. That's not going to happen this month. 2.25% for November, 1.35% for December's. Percent of the time that these months are positive, 71% for October, not happening. 76% for November, okay? 65% for December, okay? This is data going back to 1951, specifically for midterm election years. I mentioned earlier about, a 9-month correction as being, something that that we don't want. We much rather have a 1 day crash event just to get it over with, immediately. This was 2002. This was a brutal time. I remember this time. But even here, you can see that the market was in a downtrend. The bears were in control. But look at these snapback rallies. They don't seem like much, okay? But right over here, this is roughly $33 a share. The QQQs were trading at 33, and they peak right over here, call it at 38. That's roughly a 15% move in what looks to be like 1, 2, 3, 4, 5, 6 days. That's a 15% move in 6 days. That's the reason why I'm not a fan of shorting in the hole here, okay, or here. All right, in a downtrending market, I want to short these rips, okay? And also, as you can see here, you get these bounces on a consistent basis. Even here, there's a little bounce from here to here. Doesn't look like much, but this is 33 to call it 35.50. That's roughly a 5.9% move. Right over here, a month later in May, we're down to call it roughly $28. Right up to here to call it 33. That's roughly a 18% move in a matter of 1, 2, 3, 4, 5, 6 days. So these rallies, they happen, so you have to be aware of these things, okay? Whether to play them, whether to take some chips off the table, or whether to keep yourself in check and be conscious of the fact that you should not be shorting in the hole with too much capital. Here, I mentioned earlier how in the 30-minute charts, what you tend to see is these averages, they act as resistance, and then you form some type of inverse head and shoulders pattern. This was back in April of this year, April 2018, when the market was under pressure. As you can see here, the same averages that I showed before. We were 21 days below the 5-day moving average. And then over here, we were 11 days above it before we broke it here on day 12. So here we have a big downturn, big move. We have a rebound. Here's the left shoulder, the head. Here's the right shoulder. Here you see the averages start to curl higher. And, here's the 5-day moving average here, this kind of like red line. And once we get above, we tend to stay above it, and we were above for 11 days. That's for the S&P 500. Here's for the NDX, similar situation where all the averages are downtrending, acting as resistance, and then we get these bounces. We form the left shoulder, head, right shoulder, and then we get above. Price gets above these averages, and they start to act as support until they don't. But you get some relief rallies. I mean, we're talking about here 63.50 to 68.50. That's 7.8% from April 2nd to whatever this is, April 17. Here's the IWM, similar situation. Big downturn, 160 all the way down to call it 148. This is a huge drawdown. That's about 8%, if I did my math correctly. And here we have the inverse head and shoulders pattern. Here we have the moving averages acting as resistance, and then they start to act as support, and they start to trend higher. This here is a great great graph from HFT Alert. It says here, prices fall a point or two in a day or two, and every trader turns bearish on the market and sells stocks down here. Then prices rise a point or two in a day or two, and every trader turns bullish and buys back the stocks up here. All right, so again, this is another great reminder that the market goes up and down, not up or down. We tend to forget that it goes up and down right over here and right up over here. So I think the bottom line is very simple. I think that, the market is down a lot. Can the market break and go down a lot further? Yes. Can we have a crash? Yes. Everything is possible. Everything is probable. Everything is possible. I'm not a big fan of betting on outlier events, and I do believe that if you actually believe that we are going lower, which is a possibility, then I think you take the dead cat bounces to take some off the table. I mean, I can see this market, going back to right over here, 275, 278, and being a great short opportunity to remount and reload on the short side, thinking that we're going to break these levels sometime over the next couple of months. The same thing for the IWM. I think the IWM, if history's any judge, has the potential, doesn't mean it's going to happen, has the potential to bounce back right over here to 157, 160, and provide a great risk reward short trade. The same thing with the QQQs. It's got the ability, to go back to 175, which is, we're talking about 9 points divided by one. We're talking about a 5% move, okay? Back to 175, which can happen in a couple of days, and they'll provide a great, maybe a better risk reward short opportunity. So the point of the story is, look, you're going to have corrections. They happen on a consistent basis, all right? I've shown you that already. You've seen that already. They're going to continue to happen. They're going to happen in the future. You can't avoid losses. You can only contain them. You can be more lenient with your indices, with your core holdings being the SPY, QQQs, IWM. You can play around with the sizes, bring them down, bring them up. But with your individual common stocks, you got to cut them. You got to cut them quickly. You got to take your stops because sometimes they just don't come back. Okay. Again, look at some of these stocks. Western Digital down 58% from its 52-week high. So if you're a big fan of buying highs, stocks breaking 52-week highs, well, you're down 58% from there. JD down 55%. Win down 50%. Stocks go up from top, bottom, middle. It doesn't matter. But these are from 52-week highs. Down Micron, which was, a David Tepper can't miss type story. People are buying calls hand over fist. Stock is down 45% from its 52-week high. AMD is another one. AMD doubled in a matter of days. People they wanted to own AMD. They had to own AMD, and the stock just took a beating, and it pretty much just made a complete U-turn and reversed the entire gain that it had from August to September. So this roughly, whatever it is, 8% gain, 65, 70% gain gone. Okay, this is the reason why you got to take your stops. So either way, trade them well and be well. Remember that when the market is down a lot, that's when we tend to forget that it goes up and down. When the market goes up a lot, we forget again that it goes up and down. Be extremely diligent with your individual stocks. Cut them. We get a bounce. You need to sleep at night. Reduce your positions. Reduce those losers. You can always get back in. So best of luck, guys.